I just did something that shocked everyone on Wall Street. I sold every single energy stock in my portfolio, all of them billions of dollars worth of oil and gas positions, liquidated over the past several months. My team thought I was making a mistake. My colleagues questioned my judgment. Even some of my closest advisors wondered if I had finally lost my edge after 6 decades in this business. But I have not lost anything. I have seen something that most investors are completely missing, something that is going to fundamentally reshape the energy sector over the next 3 to 5 years. And when I see a major shift coming, I do not wait around to find out if I am right. I act. I have always acted. That is how I have survived and thrived in markets that have destroyed countless other investors. The energy trade has been one of the most profitable plays of the past few years, since the pandemic lows. Oil stocks have doubled and tripled. Dividends have been fat. Share buybacks have been aggressive. Investors who bought during the fear and despair of 2020 have made fortunes. I was one of them. I bought heavily when everyone else was selling. I rode the recovery all the way up. But here is what separates successful investors from the crowd. Knowing when to sell is just as important as knowing when to buy, maybe more important. The graveyard of Wall Street is filled with investors who knew how to buy but never learned how to sell. They rode their winners all the way up and then all the way back down. They gave back every penny of profit because they fell in love with their positions and could not let go. Let me be very clear about what I am telling you today. I am not saying energy companies are bad businesses. I am not saying oil is going to disappear. I am not making some political statement about climate change or the green transition. What I am saying is that the risk-reward in energy stocks has shifted dramatically. And the prices that investors are paying today do not reflect the dangers that are coming. I have made a lot of money in energy over the years. I have owned refineries. I have owned pipelines. I have owned exploration and production companies. I understand this industry as well as anyone on Wall Street. And everything I know, everything I have learned over decades of investing in this sector is telling me to get out now. Let me take you back to the beginning of my relationship with energy investing. It was the early 1980s. Oil prices had spiked during the Iranian Revolution and the subsequent crisis. Everyone was convinced that oil was going to $100, $200, that we were running out of the stuff and prices would only go up forever. Sound familiar? It should, because we hear the same story every cycle. I was skeptical. I had seen boom and bust cycles before in other industries. I knew that high prices cure high prices. When oil gets expensive, people find ways to use less of it. They buy smaller cars, they insulate their homes, they develop alternate energy sources. At the same time, high prices attract capital. Companies drill more wells. They explore in places that were not economical before. Supply increases just as demand decreases. Sure enough, by the mid-1980s, oil prices collapsed. They fell from over $30 a barrel to under $10. Companies that had borrowed heavily to drill new wells went bankrupt. Investors who had bought at the peak lost everything. The boom turned to bust, as it always does. I learned a valuable lesson from that period. Energy is a cyclical business, brutally cyclical. The highs are intoxicating, but they do not last. And the lows can be devastating for those who are not prepared. Fast forward to the 2000s. The China boom commodity supercycle. Everyone was convinced that China's growth would consume every barrel of oil the world could produce. Prices spiked to $140 in 2008. Energy stocks soared. It felt like the good times would never end. Then the financial crisis hit. Oil collapsed to $30. Energy stocks were cut in half, then cut in half again. Another boom turned to bust. Another generation of investors learned that cycles do not care about narratives. Then came the shale revolution. American ingenuity figured out how to extract oil from rock formations that were previously uneconomical production in places like the Permian Basin, and the Bakken exploded. The United States went from importing most of its oil to becoming the largest producer in the world. Prices fell because supply overwhelmed demand. Energy stocks got crushed again. And then 2020, the pandemic oil prices went negative for the first time in history. You could not give oil away. Producers were paying people to take it because there was nowhere to store it. Energy stocks hit decade lows, everyone declared the industry dead. I am telling you all of this history because it is essential context for understanding why I am selling now. Energy is cyclical. It has always been cyclical. It will always be cyclical. And right now, we are at a point in the cycle where the risks far outweigh the rewards. Here is what I see coming that has caused me to liquidate my entire energy portfolio first. And most importantly, global oil demand is about to peak. I do not mean peak in some distant future. I mean peak within the next 2 to 3 years. This is not speculation. This is mathematics. China has been the engine of oil demand growth for the past 2 decades. Every barrel of increased global consumption was essentially going to China as they industrialized and as hundreds of millions of people bought their first cars. But China's oil demand is rolling over. Electric vehicle adoption in China is exploding at a pace that most Western analysts do not appreciate. Over 40% of new car sales in China are now electric or plug, in hybrid, 40%. That number was in the single digits just a few years ago. By 2027 or 2028, the majority of new cars sold in China will be electric. Let me put some numbers around this so you understand the magnitude. China sells roughly 25 million vehicles per year. That is more than the United States and Europe combined. When 40% of those vehicles are electric, that is 10 million EVs displacing gasoline and diesel vehicles every single year. Each of those EVs represents approximately 10 to 15 barrels of oil per year that will never be consumed. Do the math. 10 million EVs times 10 barrels equals 100 million barrels of annual demand destruction. And that number is growing every year as EV penetration increases. By 2030, China alone could be destroying 200 to 300 million barrels of annual oil demand just from the passenger vehicle fleet. China is not adopting EVs because of environmental concerns. They are doing it for strategic reasons. China imports most of its oil that makes them vulnerable to supply disruptions and price spikes. By switching to electric vehicles, they reduce that vulnerability. They also happen to dominate the EV supply chain, from batteries to motors to finished vehicles. Moving the world to EVs strengthens China's strategic position while weakening the oil exporters when China's oil demand peaks and starts declining, which I believe will happen by 2026 or 2027. The implications for global oil markets will be enormous. China has been absorbing the marginal barrel of production for 20 years. When that buyer disappears, where does the oil go? The answer is that prices have to fall to find new demand, or production has to be cut. India is often cited as the next China, the next growth engine for oil demand. But India's economy is much smaller than China's was at a comparable stage of development. India is also leapfrogging directly to EVs and renewable energy. In many cases, they will not replicate the oil demand growth that China generated. The math simply does not work. Second, I am deeply concerned about the supply side of the equation. OPEC has been holding back production for years to support prices. Saudi Arabia alone has several million barrels per Dalton Y of spare capacity that they could bring online if they chose to. They have been disciplined because high prices serve their interests, but that discipline is fraying. Let me explain the game theory here because it is crucial to understanding what is about to happen. OPEC is a cartel, and cartels are inherently unstable. Every member has an incentive to cheat. If you can produce more while everyone else holds back, you get higher prices and higher volumes. You win while your partners lose. This incentive to cheat is always present, and it takes constant effort to maintain discipline. For the past few years, Saudi Arabia has been the enforcer of OPEC discipline. They have cut their own production substantially to make room for others and to support prices. They have sacrificed their own revenues for the good of the cartel. But there are limits to their patience and their willingness to bear this burden alone. There are growing tensions within OPEC. Some members want to produce more. Iraq needs revenue to rebuild after decades of war. Nigeria needs revenue to support its growing population. Venezuela needs revenue to keep the regime afloat. The UAE has invested billions in expanding capacity and wants to monetize that investment. Everyone has their own priorities, and those priorities increasingly conflict with cartel discipline. The Russia factor adds another layer of complexity. Russia is not technically a member of OPEC, but they have been cooperating with the cartel through the OPEC Plus arrangement. However, Russia's interests are diverging from the Gulf producers. They face Western sanctions that limit their options. They need revenue to fund their military operations. They are selling oil at discounts to China and India. Their cooperation with OPEC cannot be taken for granted at some point, and I believe that point is coming soon. OPEC discipline will break down. When it does, millions of barrels of additional supply will flood the market. The price impact will be severe. We saw a preview of this in 2014 when Saudi Arabia decided to defend market share rather than price. They opened the taps and let prices collapse. Oil went from over $100 to under $30. American shale producers were devastated. Many went bankrupt. The survivors had to become much more efficient just to stay alive. I believe we are approaching another inflection point where OPEC decides that defending market share is more important than defending price. The growth of EVs means that oil demand will never be as high as it is today. If you are Saudi Arabia, do you want to leave your oil in the ground forever while the world transitions away from it? Or do you want to sell it now while there are still buyers? The rational choice is to sell it now, and selling it now means lower prices. Third, the financial engineering that has supported energy stocks is running out of runway. Over the past few years, energy companies have been darlings of the market because they returned enormous amounts of cash to shareholders. Dividends and buybacks funded by high oil prices made these stocks look incredibly attractive on paper. When you look at an energy stock yielding 6 or 8% with a growing dividend and aggressive share repurchases, it seems like a no-brainer investment. You collect income while you wait for capital appreciation. What could go wrong? Let me tell you what could go wrong, because I have seen it happen before. That cash return is coming from depleting assets. Oil and gas reserves are finite. Every barrel you produce and sell is a barrel you no longer have. The reserves in the ground are declining with every quarterly earnings report to maintain production. Companies need to reinvest in drilling new wells and developing new reserves. They have not been doing that sufficiently. They have been choosing to return cash to shareholders instead of investing in the future. Look at the reserve replacement ratios. Look at how many barrels of new reserves are being added compared to how many barrels are being produced. For most companies, the ratio is well below 100%. They are producing more than they are finding. They are depleting faster than they are replacing. This is a business that is slowly consuming itself. This is fine in the short term. Shareholders love the dividends. The stock prices go up. Analysts praise management for their capital discipline. Everyone is happy. But it is not sustainable. Eventually, production starts declining because you have not replaced the reserves you produced. And once production starts declining, the dividends get cut, the buybacks stop, and the stock prices collapse. I have seen this movie before. In the 1990s, many oil companies pursued similar strategies. They maximized short-term returns at the expense of long-term sustainability. They underspent on exploration and development to boost near-term cash flow. It worked for a while. Shareholders were happy. Then it did not work. Production declined. The companies that survived were the ones that maintained a balance between returning cash and reinvesting in the business. The ones that did not maintain that balance either merged or disappeared entirely. Fourth, the regulatory and political environment is turning increasingly hostile to fossil fuels. This is not a political statement. I am simply describing reality. Governments around the world are implementing policies designed to reduce oil and gas consumption. Carbon taxes, emissions standards, EV mandates, renewable energy subsidies, bans on new internal combustion vehicle sales. You can agree or disagree with these policies. That is not the point. The point is that they exist and they are expanding. Every new regulation makes it harder and more expensive to produce and consume oil and gas. Every new policy tilts the playing field a little more against fossil fuels and toward alternatives. The smart money understands this. Large institutional investors are reducing their exposure to fossil fuels, not because of morality, but because of fiduciary duty. They see the regulatory trends, they see the demand trends, they see the stranded asset risk, and they are getting out before everyone else realizes the same thing. Fifth, and this is something that very few people are talking about, the cost structure of the industry has deteriorated significantly. It costs more to produce oil today than it did 5 years ago. Service costs have increased, labor costs have increased, equipment costs have increased, regulatory compliance costs have increased. During the shale bust of 2015 and 2016, the industry cut costs dramatically. They laid off workers, they renegotiated contracts with service companies, they improved efficiency through technology and better practices that created room for healthy margins even at moderate oil prices. But those cost savings have been reversed. The service companies that survived the bust raised their prices as activity recovered. The workers who were laid off found jobs in other industries and have to be lured back with higher wages. The easy efficiency gains have been captured. There is not much more room to cut. This means that the break-even price for new production has increased significantly. Wells that were economical at $50 per barrel now need $60 or $70 to generate acceptable returns. The cushion between the current oil price and the break-even cost has shrunk. And when that cushion shrinks, companies become much more vulnerable to price declines. Now let me talk about what I think is going to happen over the next few years and why I have completely exited the sector. I believe we are going to see a significant and sustained decline in oil prices, not a temporary dip like we saw during the pandemic, but a structural decline driven by demand destruction and supply increases. I believe oil could fall to $40 or $50 per barrel and stay there for years. At those prices, most energy stocks will be devastated. The dividends that investors love will be cut. The buybacks will stop. The earnings will evaporate. Companies that loaded up on debt during the good times will face financial distress. Some will go bankrupt. The energy sector has been a market darling for the past couple of years. It has outperformed technology and other sectors. Money has flowed into energy ETFs and energy mutual funds. Retail investors have bought the stocks for their dividends. This enthusiasm has pushed valuations to levels that assume the good times will continue indefinitely. But cycles do not work that way. The best time to sell is when everyone else wants to buy. The worst time to sell is when everyone else wants to sell. Right now, everyone wants to buy energy. They point to the dividends, they point to the cash flow, they point to the geopolitical risks that could send prices higher. They come up with reasons why this time is different. This time is never different. Let me address some of the common arguments I hear for why energy stocks will continue to perform well. The first argument is that geopolitical risk will keep prices high. Wars in the Middle East, tensions with Russia, instability in Venezuela, these risks are real. A major disruption could indeed cause a price spike. But price spikes from geopolitical events tend to be temporary. The underlying supply and demand fundamentals reassert themselves eventually. Moreover, geopolitical risk works both ways. Yes, a war could disrupt supply and push prices higher, but a recession could destroy demand and push prices lower. A diplomatic breakthrough could remove sanctions and flood the market with Iranian or Russian oil. The geopolitical dice can roll in either direction. I do not invest based on predicting geopolitical events. I invest based on fundamentals. And the fundamentals are deteriorating. The second argument is that OPEC will defend prices. They have the spare capacity to cut production and support the market. They have done it before and they will do it again. This argument has merit in the short term. OPEC has indeed been cutting production to support prices. Saudi Arabia in particular has shouldered most of the burden. But there are limits to how long this can continue. Every barrel that Saudi Arabia does not produce is revenue that they do not receive. They have expensive social programs and economic development initiatives that require funding. They can tolerate lower production for a while, but not forever. More importantly, cutting production to defend price only works if demand is stable or growing. If demand is declining, as I believe it will be. Cutting production simply means permanently losing market share. You cut production, prices stay flat because demand is falling. and you have less oil to sell. That is a losing strategy. At some point, OPEC will decide that volume is more important than price. When that happens, the price collapses. The third argument is that the energy transition will take decades and oil will remain essential for the foreseeable future. This is true. Oil will not disappear overnight. The world will still be consuming oil in 2050 and beyond. But stock prices are not determined by whether a product will exist in 30 years. Stock prices are determined by growth expectations and profit margins. A product can be essential and still be a terrible investment if the growth trajectory is negative and margins are compressing. Tobacco is still consumed by hundreds of millions of people. Tobacco companies still generate billions in profits, but tobacco stocks have been poor investments for decades because growth has been negative and the regulatory environment has been hostile. Energy could follow the same path. The fourth argument is about energy security. Countries need reliable energy supplies. They cannot depend entirely on intermittent sources like solar and wind. Fossil fuels will remain the backbone of the energy system. This argument confuses the physical necessity of energy with the investment merits of energy stocks. Yes, the world needs energy, but that does not mean energy companies will be profitable investments. Utilities provide essential services, but utility stocks have been mediocre investments for decades. The returns to energy investors depend on pricing and margins, not on the essentiality of the product. And pricing and margins are under pressure from the trends I have described. Let me tell you what I am doing with the proceeds from selling my energy positions, because capital allocation is just as important as knowing when to sell. I am moving into sectors that benefit from the same trends that are hurting energy. I am looking at companies that make electric vehicles and EV components. I am looking at companies that build charging infrastructure. I am looking at utilities that are investing in renewable generation. I am looking at companies that provide the copper and lithium and other materials that the energy transition requires. This is not about ideology. I do not care about being green or saving the planet. I care about making money. And the money is moving from fossil fuels to electrification. I want to be positioned where the capital is flowing, not where it is draining away. I am also holding a significant amount of cash. When oil prices decline and energy stocks collapse, there will be opportunities to buy distressed assets at attractive prices. I have made some of my best investments buying assets in down cycles when prices were irrational, when the energy bust comes. And I believe it is coming. I want to have the firepower to take advantage. Let me talk about timing, because I know that is what everyone wants to know. When exactly will energy stocks collapse? When should you sell? I do not know the precise timing. Nobody does. Cycles do not operate on schedules. They unfold based on the interaction of countless variables that are impossible to predict with precision. I could be early by 6 months or a year. The stocks could go higher before they go lower. But I have learned over 60 years that trying to time the exact top or bottom is a fool's errand. What matters is recognizing when the risk-reward has shifted unfavorably and acting accordingly. The risk-reward in energy stocks has shifted unfavorably. The potential upside from here is modest. The potential downside is severe. That is all I need to know. I would rather sell a year early than a day late. Being early means leaving some money on the table. Being late means losing a fortune. I know which outcome I prefer. Some people will look at my energy sales and conclude that I am bearish on the economy. That is not correct. I am not predicting a recession. I am not predicting a market crash. I am simply saying that energy is a sector with deteriorating fundamentals and an unfavorable risk-reward at current prices. You can be bullish on the economy and bearish on a specific sector. The two are not mutually exclusive. The economy grew throughout the 1990s while tobacco stocks underperformed. The economy grew throughout the 2010s while retail stocks got crushed by e-commerce. Sector rotation happens within bull markets all the time. I believe we are in the early stages of a major rotation out of fossil fuels and into electrification. This rotation will take years to play out. The investors who recognize it early will profit. The investors who cling to the old paradigm will suffer. let me address one more thing. I know that some of my investors and followers own energy stocks. I know that some of you bought them because I was buying them in the past. And I know that selling now means acknowledging that the thesis has changed. Changing your mind when the facts change is not weakness. It is wisdom. The worst investors I have known are the ones who refuse to admit they were wrong. They held on to losing positions because they could not accept that their original thesis was flawed. They averaged down into declining stocks because they could not accept that the trend had turned against them. I have no ego invested in my energy positions. I owned them because I thought they would make money. I am selling them because I now think they will lose money. The situation changed. So my positioning changed. That is how investing works. You should feel no loyalty to any stock or any sector. Loyalty is for your family and your friends. Stocks are just pieces of paper representing ownership of businesses. If the business outlook deteriorates, you sell. It is that simple. When I first started accumulating energy stocks several years ago, the setup was different. Oil prices had collapsed during the pandemic. Sentiment was extremely negative. Valuations were at historic lows. The companies were trading below the value of their reserves. That was a classic setup for a contrarian investment. The thesis played out, oil prices recovered, energy stocks soared, I made a lot of money. But now the situation has reversed. Sentiment is bullish. Valuations have expanded. The easy money has been made, and the fundamental outlook has deteriorated. When the facts change, I change my positions. I am not married to any investment. I am married to making money for myself and my investors. Right now, making money means exiting energy. I want to leave you with a final thought about what I have learned over 6 decades of investing. The most dangerous time in any cycle is when everyone agrees about the future. When everyone is bullish, there is no one left to buy. When everyone is bearish, there is no one left to sell. Crowded trades eventually unwind, and the unwind is always painful for those caught on the wrong side. Right now, energy is a crowded trade. Everyone owns it. Everyone is bullish. Everyone has a story about why prices will stay high forever. That consensus makes me very nervous. I have seen this pattern before. I saw it in the late 1970s when everyone was bullish on oil. I saw it in the late 1990s when everyone was bullish on technology. I saw it in 2006 and 2007 when everyone was bullish on housing. The consensus is always strongest right before the turn. I am not predicting a crash. I am simply observing that when a trade becomes this crowded, when the consensus becomes this unanimous, the risk-reward tilts unfavorably for those who stay in. The smart move is to take your profits, step aside, and wait for the next opportunity. That is exactly what I have done. I have sold my energy stocks, I have taken my profits, and I am waiting to see how this plays out. If I am wrong and energy stocks continue to rise, I will have left some money on the table. That is fine. I have left money on the table before, and I will do it again. But if I am right, and I believe I am, the investors who stayed in energy will suffer significant losses. The stocks will fall. The dividends will be cut. The dreams of easy money from fossil fuels will evaporate, and I will be sitting on the sidelines with cash, ready to buy whatever is cheap when the dust settles. That is how I have always operated. That is how I have compounded wealth for over 60 years. And that is why I just sold every energy stock I owned. I want to share one more thing with you before I close, because I think it is important for understanding how I approach major market shifts like this one. Throughout my career, I have found that the biggest opportunities and the biggest risks come during transitions. When an industry is moving from one phase to another, when technology is disrupting established business models, when government policy is shifting in fundamental ways, these transitions create winners and losers. And the key is to be on the right side. The energy transition that is happening right now is one of the biggest economic shifts of our lifetimes. Trillions of dollars of capital are moving from fossil fuels to electrification. Entire industries are being created and destroyed. The companies that dominate energy today will not necessarily be the companies that dominate energy tomorrow. I am old enough to have seen previous transitions. I saw the shift from mainframe computers to personal computers. I saw the shift from traditional retail to e-commerce. I saw the shift from traditional media to digital media. In every case, the investors who recognized the transition early and positioned accordingly made fortunes. The investors who clung to the old paradigm lost fortunes. The energy transition is following the same pattern. The early signs are already visible for those willing to look. EV adoption is accelerating. Solar and wind costs continue to fall. Battery technology is improving rapidly. The economics are shifting in favor of electrification. I do not know exactly how fast this transition will happen or exactly which companies will win. But I know that being positioned in declining industries is a recipe for poor returns, and I know that fossil fuels are a declining industry regardless of what happens in any individual year. So I have made my choice. I have sold my energy stocks. I have redeployed the capital into areas that benefit from the transition rather than suffer from it. And I will watch from the sidelines as this plays out, ready to take advantage of whatever opportunities emerge. That is the approach that has served me well for 6 decades. I see no reason to change it now.